I'm Murli. I've been working with Franklin Templeton 19th year since 2007, and I'm the part of the portfolio management team for the Franklin India equity strategy. I think India had one of its worst relative years in 2025, underperforming the emerging markets benchmark by about 40%. But if you look at the structural drivers of Indian economy, which is GDP growth, that continues to be around 7%, and then which eventually translate into mid-teens earnings growth if you take any 3 or a 5-year bucket. So that naturally translates into low teens dollar returns for investors if you stay patient and then stay invested. There is no deterioration of political environment. There is no deterioration of corporate, I think, profitability. I think those continue to remain very stable. The cost of capital continues to come down in India. The participation of the domestic investors continues to increase. So the risk premium for Indian market is, I think, coming down on a structural basis. So overall, I think the growth, combination of the domestic growth, the importance of democracy, I think India being a large democracy and then vibrant democracy, and then I think high quality corporate governance, I think they will continue to drive the shareholder returns for a long time in India. Consumption is a big part of Indian economy. About 2/3 of the GDP is from consumption. And in a scenario wherein I think your per capita income is still about $2,500 and the incomes are growing in double digit, I think consumption continues to be a big opportunity for the investors, be it in, I think, banks, be it in consumer discretionary, particularly in autos, in retailers, in travel and tourism, or in, I think, hospitals. Even real estate is, I think, one of the underappreciated sectors. The sector has corrected more than 30% last year on fears of cyclical slowdown. But I think the fears are unwarranted. I think it's mostly in the low-end housing, not in the high-end or premium or luxury side. I mean, just to give a number, India only makes about 500,000 apartments in a year compared to about 20 million in China at its peaks for a similar population. So the structural growth opportunity is still very, very strong. So there are a couple of, I think, risks. One is structural, one is more geopolitical, but also maybe you can call it a structural risk. So the first one is the risk of AI. India has about 7 million people working in IT and IT related services, which is about 1% of the workforce, and their average salary is about 4 times that of the non-IT workers. So that is a big employment generator as well as, I think, a big wage creator. So the forex earnings from IT services is also quite large, close to about $250 billion. So any disruption by AI into this business, this exports, I think could be long-term negative. But if the disruption is manageable, let's say the overall services shrink only by about 10-20%, because most of the I think IT services firm cater to the enterprise IT, where the change, I think, is very difficult to make, or I think it doesn't happen that quickly. So I think we believe at this point of time the situation is manageable, but we are waiting and watching. The second risk is geopolitical, wherein we have tough neighbors like Pakistan, China, and even now Bangladesh. So I think it increases the need to invest in defense. So your defense budget needs to go up. At the same time, you're investing more in capex, investing more in cutting taxes to promote consumption. So it's a fine line India has to walk between, I think, increasing spending on all these 3 items.